Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Cameco stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Cameco is the world's largest uranium company, accounting for 18% of all production. The company is headquartered in Saskatchewan, Canada, and was founded in 1988. It went public in 1995 and currently trades on the New York Stock Exchange, TSX, London Stock Exchange, and the Frankfurt Stock Exchange. Uranium provides us with nuclear fuel used to generate electricity in nuclear power plants. It's also used for nuclear weapons, and it's also in things like fertilizer. Cameco operates uranium mines in Nebraska, Wyoming, Saskatchewan, and Kazakhstan. Let's get started with the model. This is a mid-cap company, 6.5 billion market cap. They're trading at $16.41 a share, and they have 397 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had positive free cash flow in 2017, 18, and 19, but negative in 2020. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that's negative in 2017 and 20, positive in 2018 and 19. Revenue is the sales for the company, and that doesn't look so good. It decreases each year from 1.7 billion to 1.4 billion. This is the company's income statement. All the numbers are in Canadian dollars. I converted these numbers to US dollars on my spreadsheet. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Below that is their gross profit, which is revenue minus cost of revenue, and that was the lowest in 2020. Below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income. And they had negative operating income in 2020, positive in prior years. They paid $57 million of interest on their debt, which is the lowest they paid in the past 4 years. Then there's other income and expenses, and that was positive in 2020, $86 million, negative $339 million in 2017. And the bottom line of the income statement is their net income, which was negative in 2020, positive in 2019 and 18. The only reason it was negative in 2017 was this large other income and expense of $339 million. I would focus on operating income when I look at the income statement. That's a better indicator of a company's financial health. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. You can see they only generated $57 million of operating cash flow in 2020, about 10% of 2019's number. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they did have negative free cash flow in 2020. They did have a good amount of free cash flow in prior years, $450 million up to $612 million. The company does pay a small dividend. Before 2020, they were generating a good amount of free cash flow, so they paid down $500 million of debt in 2019. In 2020, they also paid down $400 million of debt, but they issued $400 million of debt. So that's pretty much a wash. Let's look at the capital structure. $4 billion of equity, $800 million of debt. They're 83% equity, 17% debt. Their net debt is $42 million, so they could pay down almost all the debt with the cash on their balance sheet and only have $42 million of debt left over. Their WACC is 7.77%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5 billion. We divide that by 397 million shares. And we get a calculated stock price of $12.54. They're trading at $16.41, so they're trading at a 31% premium. It's a sell according to the model. Simply Wall Street is much lower than me. They're at $3.43 a share, so they're saying the stock is extremely overvalued. 8 analysts priced this stock in the past 3 months. The average price target was $18.57. The low was $12, the high was $23. So you can see the stock has done pretty well the past 5 years. It's almost at its all-time high. I do expect the stock price to come down a little bit because they are putting up pretty weak numbers. And they pay an annual dividend of 6 cents. They seem to be cutting their dividend. It was 7 or 8 cents. Now it's down to 6 cents. They pay a really small dividend, 0.37%. And they have negative net income and negative free cash flow, so we can't look at the dividend payment as a percent of those two numbers. The bottom 25% pays a 1.2% dividend yield. They're much lower than that. Their industry pays a 5.2% dividend, and analysts are forecasting their dividend yield to grow to 1.4% in the next 3 years. They have a pretty low beta, 0.76, so the stock is not too volatile. The stock has gone up 64% in the past 52 weeks, while the S&P 500 went up 45%. The 52-week low is $9, the high was $20. And the stock is trading above its 200-day, but below its 50-day moving average. About 4.5 to 6.5 million shares are traded each day on this stock. Of the 397 million shares outstanding, 396 million are on float, 68% are held by institutions, and a little over 2% of the shares are shorted. In the past year, this stock has gone up 62%, while its industry went up 51%, the market went up 59%. This stock has outperformed its industry in the past 3 years and 5 years because its industry went down. The market went up a little more in the past 3 years, but in the past 5 years, the market went up 124%. Analysts are forecasting their earnings to grow 63%, while its industry grows 44% and the market grows 18%. Although analysts are forecasting their revenue to decline 2.5%, their industry to increase 8.5%, and the market to increase 10%. In the past 5 years, their annual earnings grew 15%, while their industry grew 7% and their market grew 12%. But in the past year, their earnings decreased 170%, the industry decreased 45%, and the market increased 5%. If you invested $10,000 into this company 10 years ago, you would have lost money anytime you sold. If you're currently holding on, you're at $6,700 today. That's a 4% annual loss. The biggest shareholder is T. Rowe Price at 5%, then William Blair, Vanguard, Copernic, and Exor. Let's look at their financial ratios. The average PE is 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Price to sales is stock price over sales per share. They're at 4.5. That means investors are paying $4.50 for $1 revenue. That number is between the median and average. Price to book is stock price over book value per share. They're at 1.6. That's much better than the median and average. Their return on invested capital is negative since they have negative EBIT. Same thing with their interest coverage ratio. It's negative because they have negative EBIT. Their ROE is negative because they have negative net income. They have a really high current ratio of 6.4, so they can cover their current liabilities almost 6.5 times. Their current assets are cash of $940 million, receivables of $230 million, and inventory of $770 million. The company does seem to be well capitalized. They did have negative $16 million of free cash flow, but they have $1.3 billion of working capital and a small $24 million dividend payment, so they have almost $1.3 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on Uranium Energy Corp, which is in the same industry as Cameco. Both companies have negative earnings, so we can't look at the PE. Uranium Energy doesn't have any sales, so we can't look at their price of sales. Cameco has a much better price to book. Both companies have really high current ratios. Both companies have negative ROE. Cameco is a little lower in debt, and Cameco is about 10 times as big as Uranium Energy. And Cameco pays a small dividend, while Uranium does not. So to summarize, I have them trading at a 31% discount. The future of this company is based off of two things: the demand of uranium and the price of uranium. If you can predict those two things, then you could really figure out how this company is going to do. I rank their free cash flows 3 out of 10, revenue 5 out of 10, and ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.